Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, August 31st, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take another look back at the episode that we did last week on selling a put option. Made some moves as I was editing the video. Want to talk about that a little bit. And we're also going to cover another concept called the covered call. We've done some episodes in the past, but I think we'll take a little bit of a look at that and talk through it with the same Amazon share. But before we get to that, let's give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear what you're interested in. Let us know, and we will make some content pertaining to that. You can also find this episode wherever you get your favorite podcast. Look for Blockhead Traders. And if you don't find it there, drop us a note and we will get it there. Let's hop to this week's content, Viper. So Viper, last week we talked about selling an option, and we really went into a lot of the different details and the mechanics of what actually is selling an option. And we did it by selling a put example in Amazon. And we recorded that video on a Wednesday. The market kind of carried on. I ended up editing that video a little bit later that coming weekend. And on Monday, I happened to be kind of looking through my trading terminal. And I said, Amazon has kind of dropped a little bit more from when we actually recorded the episode. And I noticed volatility had come up a little bit. There was some news coming out about economic conditions and how things weren't as rosy as people thought. Chairman Powell came out from the Jackson Hole summit that they have as the Federal Reserve, basically saying he's going to really clamp down on things. Things are not that wonderful. I think the market was really hoping that next year he was going to give some clue that he might be dropping rates or something, which, whatever. I think that's a little bit crazy. But anyway, Amazon is one of these large technology staples that is kind of in the world of both technology as far as their AWS cloud infrastructure and things like that, but they also, deliver socks and groceries and a lot of the consumer staples. And everybody, my neighborhood is just full of these Amazon Prime trucks just darting around all the time. And so, I think they're an interesting play where they get hit a little bit with technology, growth hindrance news, but at the same time, they're kind of also propped up and get their money from, these consumer staples and these more recession-proof type of items. And so it's a really interesting play just from that like macroeconomic view. And I happened to look at the option chain and I said, you know what? We covered this and I had screened it for last week's episode as a potential high volatility percentage, like the IV was extended. It was a nice selling play. And so I actually ended up making a trade on Monday, selling a put, a 115 put. And so I just want to kind of jump to, recap, and I updated the same charts that you saw from last week where we were talking about why we were entering this or why we were even talking about this. So let me pull up this chart right here to start us off. And this has been updated. So when we talked about it in last week's episode, it just come off this big gap down. So it was kind of coming off this high. We had this gap down, and I have actually updated this green box here. And the green box is the profit of where I sold my strike. I sold this 115 strike. And remember, what this means is I said, look, I will buy Amazon for $115 a share if it gets down there, but I want to collect some premium for it. And so, I sold this 115 strike. I created this option contract that said, I will buy your shares for $115 if you pay me, in this case, a $2.60 premium per share. So I collected $260. And so this yellow box here is that $260 or $2.60 below that strike price, where I can still profit even if my strike is breached. And so when you look at where this actually is in the price action, I kind of like it. So I didn't put the levels up here that we talked about last week, but right here where we have these couple peaks here before this gap up, this potentially is a support level, just this localized support level, because it was resistance here and here. We gapped up and we're kind of coming back down to test it. It's not been tested once we've kind of breached it. So we could be looking for some sort of reaction here in the coming days around this 125 strike. I am relatively confident in this whole. Remember, the thesis that we talked about last week was it's not that I'm bullish on Amazon. It's that I don't think it's going to decline dramatically. Because remember, when you're selling the option, you're making money in all but one direction, and that is a significant move down. And so, if this level fails, yeah, we might kind of drop down, but how quickly are we going to drop down? Where are we going to get there? Where are we going to breach the strike? Because remember, this is a time-bound trade. My trade is over on October 21st. Could be over sooner if we rally, but this is my time box that I'm playing in. So remember, my thesis here is really that Amazon just is not going to drop significantly within this time box window between when I made the trade on Monday, which is the left side of this box, and when the option completely expires worthless, which is the right side of this box. Is as long as we stay above this $112.40 mark, I'm golden.
Yeah. So one thing, looking back at this chart, that we talked about last week, that I like, because I agree with that same thesis mentality of, it's not that you think that it needs to take off or anything like that. Or bullish was the better way to phrase it. That not that you think you're super bullish on this or anything, just acknowledging where it's at in the phase of price action. And so, real quick, I just wanted to throw out on my chart here. If we look at the monthly, and so this kind of is just to add some more colorization here to the thinking process. On the monthly chart, we can see that down here at 101, somewhere around the $100 level was a fairly significant monthly level. And we say significant because you can see we had 3 tests from the bottom side of that back throughout 2019. And then in 2020, we actually gained the level. We went up to all-time highs. And now what's happening is we've come back and we've tested it and so far proven support of it. And so just putting out my mentality of, agreeing with that idea of the thesis of it doesn't, you're not saying the thought process is, we're going right back to 180 or anything like that, but it's doing the right things to hold the level. Now there is still some price action that needs to continue to happen to do that, but all that is to say, owning the shares at 115 plus the premium, as far as the chart goes, that I'm seeing, that seems to be, checks out, on an acceptability risk level.
Yeah. So, I mean, talking about the risk level and, the potential return, let me jump over here to the chart, not the chart, but the table of really what was my move. Let's summarize it. This is the same type of thing that I pulled up last week when we went through that episode, and I've updated it to my actual play that I put in. So like I mentioned earlier, the thesis here is Amazon will not lose big. So on August 29th, I went and I sold 115 strike price on the put. Now, that was actually a 20 delta. So if you remember last week, we talked about deltas. We talked about selling a 30 delta. This is actually a 20 delta. So it's further out of the money. And what that really means, if I remind you, is that you can think of as the percent chance that that will be at that strike price at the time of expiration. So there's a 20% chance that Amazon will be at $115 at expiration. So that means I, the seller, actually have an 80% chance of winning or profiting from this because I make money if it doesn't reach that strike and go lower. And I was actually able to sell this for $2.60. Like I mentioned, that is a collection of $260 because I only did one contract and each contract represents 100 shares. So I collected $2.60 premium for every share in the contract, which is 100. So the interesting thing here, Viper, is if you recall from last week's episode, I believe we were collecting somewhere around $450 or $460, but the buying power that we needed for that 30 delta yielded a 19% potential profit. Well, I've increased the odds. So that was a 30 delta. So I had a 70% chance of gaining that. Now, this week, because volatility expanded a little bit, the price dropped a little bit, I was able to push that strike farther out, a whole 10 delta, give myself higher probability of success. And my calculation is actually an 18.5% potential profit because I only had to put up $1,400 in buying power for that 20 delta. So that 18.5 is simply gained by taking 260 divided by my $1,400 in buying power that I had to put up, yielding almost a 19% return with an 80% chance of profit. And like we mentioned, the worst case is I'm going to be a buyer of Amazon for $112.40. Just like last week, you might think, I thought you sold this thing for $115. Well, I did, but I collected this premium. And so my cost basis, if I get assigned Amazon shares, is actually my strike price minus my premium, because that's money that went right into my pocket when I sold that. And so being long Amazon at $112.40, in my opinion, is not so bad, given my thesis on the company that we're not really in a position to be tanking out the wazoo here.
Yeah. And so pivoting slightly then to, okay, so that's all well and good on, being willing to sell that naked put contract, but there's still, I think, a realm of person out there that, and I'm saying this because I was that person, that just the concept still is hard to grasp on selling the naked put. And so I wanted to go into now a slightly different way that you can still use these options in what I think might be a little bit more of an understandable mechanic. So, and that is the covered call. So if we look at my chart again here, basically we can see the price action here. We see the test down. So now we're looking at the daily. We see the test down at $100, and we see the bounce up that we had recently that we're currently retracing off of. We leveled these. We identified these levels in last week's episode. But what I want to call out is that obviously we topped out here at 145 before we began the trend reversal, and confirmed the trend reversal just now as we lost the 130 here. So what I think is another interesting way to play this and utilize options to your benefit is, okay, so I still have the same thesis as what Sprocket laid out, which is just, okay holding these or hanging on to some shares. So let's just say right now at $126, the only thing I'm really familiar and comfortable with is buying shares. So I go out there and I pick up 100 shares at $126 spot buy. Now I have them in my hand. And now forget options for a second. Price action, which, I mean, I guess, so price action would say maybe don't buy right now at 126 because we are in a downtrend and we have a level coming up to test. But the reason I'm okay with 126 will make a little more sense here when we get into the option side of things. But buying now, price action says if I want to set some profit targets, I should really think about setting some profit targets at some of these levels we've already identified that we've fallen from. And particularly, I'm going to set 145 here, which is that level where we retraced off of. I'm going to set that as my maximum. I'm not even looking to play this thing back to all-time high. I just want to get back to the level that we just gained on the upswing, and I want to sell it all there. So I say that's my profit target, 145. And that's a pretty straightforward play. I think we all understand that. Buy low, sell high. That's the dream. But it never happens in the timeline that you want. Maybe that, and like I said, price action does say at 126 here, we've already lost that 130 level. You can see marked here. So price action says we're going to go test the 122 level. But nonetheless, if I was going long, I would peel profits here at 145. So what can I do now that I'm holding these shares to better utilize my time and possibly squeeze a little extra profit out of it? And that's where a covered call comes from. So a covered call is saying, I have the contract's worth of shares in my possession. So I have a contract. I have a 100 shares of Amazon. Who wants to buy this? Will somebody buy this from me? And let me just sell you that contract. And so, hey, my profit target is 145. Sprocket, do you have numbers on what are people bidding or paying right now for a 145 covered call?
Yeah. So
Or
the way that
covered
you
call, but
yeah, the option chain. So the way that you
Yeah.
would look at this is you would go to your brokerage and you go to the option chain. And right here on the screen is the option chain. And right here is the October 21st strike. So this is 51 days out from today. And you have your bid and your ask. This is basically, the buyers and the sellers of that particular option. And if we come down to the $145 strike, which is right here, you'll see that right now people are willing to sell it at $169 and people are willing to buy it at $165. So probably your fill, or where your order would get placed at, will be in the middle of these two bid and ask prices. And so that $145 strike, you should be able to sell one contract of that for about $170.
so now I've taken these shares and I've gone ahead and already locked in some profit on what would have been just a limit order to sell. So mechanically that's happening. I've collected $170 in my pocket, and now if price goes back to 145, that most likely, timeline matters as to when it gets there or whatnot, but let's just say it hits and it gets assigned, those shares go away, I get my profit from what was going to be a limit order anyways, and I pocket that $170. So now, you could almost think of it as that was $170, that was $1.70. So two ways that I like to think about that when you look at that premium number is, call it 145 even is where it got assigned away. I collected $1.70, $1.70 per share. So that essentially was like selling at $146.70. So it was actually selling a little higher than where my limit order would have triggered. Because if we look at the chart, 146.70, if we're going to, give this this level a test and maybe reject off of it again, 146.70 might be out of reach. It's just above a previous wick that we had. And then on the flip side, right after I sell that, I just said I bought at $1.20 or 126.70 is where the current price is. So now, because I've pocketed that 170, it was equivalent to having purchased those 100 shares without involving options at 126.70 minus $1.70, thus $125. So that's just ways to start thinking about efficiency of it, and when you're looking at those premiums and collecting them, that's to me, that naked puts and covered calls, some of my favorite ways to utilize options. And especially covered calls when you think of it in that mindset of, I was going to sell these things anyways. So if I was going to sell them anyways, why not just harvest a little bit more profit? And on the other side of being regimented, nothing makes you more regimented than locking yourself into a contract with somebody at a price that you found favorable. Now you just let it ride. And maybe it doesn't get back up there. Maybe the contract expires, and if it expires, let's spin the wheel again. I mean, maybe wait for some volatility. We can get into strategies that way later, but it just gives you flexibility to continue to maximize your earnings.
Yeah, and honestly, the covered call is probably the best entry point for any beginner because it is, like you said, one of the closest things to what they're kind of comfortable with. You're going to buy and long shares anyway because that's what the majority of entry level retail traders do. They don't short shares, they don't do these things. They basically pick a company, they buy it, they hold it, buy low, sell high is the ideal. And, this just gives you an option that if you happen to have 100 shares of anything, you can look to sell a call option against it and collect that premium. Because in this case, if that Amazon would go up to, let's say, just $140, when you hit that October 21st date, that option is worthless. It's gone. It's expired. It's done. It's all over. And so if they don't make it to that strike, you keep your shares, you keep the premium, and sell another one. So, it's a great way to kind of create a steady income from a base of shares that you happen to be holding, maybe for a dividend, maybe for a long, slow burn growth, anything like that. It's just a way to augment or squeeze a little extra dollars that come out. And as long as you set your strike price that you're selling this thing at above what you paid, you're making a profit. And I know a lot of people get, sad when they don't make, max profit. I didn't get the exact top, but nobody ever got in trouble for making a profit. In fact, a huge percentage, the majority of retail traders don't even see green profits over a long period of time. So it's just one of those things that it's that baseball analogy, single after single after single is going to win you a championship. It's not going to be the occasional grand slam.
Yeah. I mean, I think at the end of the day, psychology is important, and shaking yourself out of that mentality of hitting the grand slam, hitting the game winner, bottom of the ninth World Series grand slam, shaking yourself out of that mindset. And then, I mean, frame it however you have to. I mean, what would you rather say? I hit the bottom of the ninth grand slam winner, but that was the only game I ever played in baseball? Or, or I've had a career, 20-year long career. That's probably a little too long for a baseball player, but nonetheless, I had a excessively long career, and my runs batted in was just crazy high, and I never hit a single home run. Like, I mean, however you need to frame it, but getting out of that mindset and getting out of it by showing yourself the other side, which is to say, hey, in this market, in any market, would I take a more green portfolio or mostly a loss with maybe a 1% chance of a massive win? And I mean, and let's call it what it is. Then you're either gambling or you're trying to grow wealth.
Yeah. And honestly, even shooting for that grand slam or trying to swing for it, like, okay, it's exciting, a few times that you get it, but you're going to strike out a lot. And I'm not saying don't swing for the fences, but that mental game can be very discouraging. And if you constantly lose and lose and lose, there is this mental block that's going to come in and make you feel like you got to double down next time. You got to take a bigger risk because you got to make up lost ground. And that just kind of drives people into this downward spiral of just taking on excessive risk. And so just be realistic and just shoot for the things that are easier to control. Probability is in your favor. It's not a race, it's a journey. and you're going to get there one step at a time. You're not going to get there one marathon at a time or some just sprint.
Yeah. And the last thing I'd say on it before we beat the horse completely dead is that mentality of lose, lose, lose makes you want to double down. It flips the other way exactly the same. You hit the grand slam, you get this massive win. Two things are very likely to happen in your mentality. One is potentially a drawback of like, oh, wow, you look around and you're like, how did I even get that? I can't repeat that. How did I even get here? And then you feel lost of, I don't know what to do next. I don't know where to go. And then the second thing trickles in, which is like, well, I did that. I threw it all on black and I doubled down. So I think I should just do that again. Like, you do what you know. And if all you know was hitting the grand slam, you will just continue to waste your money because the probability of you doing it again and again is really low. Even lower than the first one.
Yep, absolutely. It's like that whole coin flip, right? You got a 50-50 shot the first time to get, heads or tails. To get the same thing again, you got, you'd cut that in half. To get that again, you cut those odds in half again, and they just get exponentially tinier. That brings us to the end of this week's episode. I thought it super interesting that I ended up taking that Amazon play that we talked about last week. So, we'll keep track of that. You can visit thetagang.com/Sprocket 888. where I post all my trades, the good, the bad, the ugly. That trade's on there. You can follow it. We'll probably check back in on it at some future episode. We also introduced that concept of the covered call, and that really is a more comfortable strategy to kind of get your feet wet with on options, which isn't really that different than a traditional buy and hold strategy. It's just this extra thing that kind of goes in there, can squeeze a little more profit out, a little more premium into your wallet. Great way to first get an exposure. Other than that, there's a lot of exciting things happening in the market. The summer doldrums, which is really where a lot of the big traders go away, is kind of about to come to an end, as all the big traders are kind of coming back in, and fall is sure to be quite an exciting time in the markets. So good luck out there as you cruise through them. Have fun, and remember, think outside the block.